A very good morning to all of you students. Today we will be discussing about the mergers and acquisitions and startup finance. These are live revisionary sessions. So let's start with the first topic of mergers and acquisitions. So in mergers and acquisitions, we first of all discussed about some of the situations that occur basis which we will have to do our further processing. So what are these some of the situations? The first situation that we discussed was, let's assume there are two companies, company A and company B, and the merger and acquisition happens in such a way that company B merges into company A and company B loses its legal identity. That means it gets dissolved. And after merger, only company A remains. So this is one type of a merger that I think all of you would have seen in the market that it has been operating, right? So this is called as purely merger, right? Because one company is getting merged into another company, and the company which has got merged has loosened its identity. The other company in which the merger has happened still remains as a continuing legal entity. The second type of mergers and acquisitions is wherein there are two companies A and B. Now A is acquiring a majority stake in the B Limited in a way that A acquires B. So whenever we say that some company has acquired another company, this will typically happen once they take the majority of the stake, right? Which is more than 50% of the equity. So in this case, what will A become? A will become a holding company, right? And B will become a subsidiary company. But an interesting fact to note here is that B will still continue to be a ongoing legal entity, right? B will not get dissolved. So that's where we are saying that the B's legal entity and A's legal identity both will be separate. And whenever we talk about from a group perspective, both A and B will get, will get seen together in terms of any analysis. So this is also one type of merger and acquisition. So, very roughly speaking, this is an acquisition. The case 2 is an acquisition and case 1 is a merger. Okay. Then let's come to third case. Now let's assume there is a company called A and it has two different business divisions. The first business division is into textiles and the second business division is into perfumes. So the textile and perfume business division are managed in such a manner that they have totally different people. The management is separate. The locations in which they operate is separate. The offices are also separate, right? It's just that both of them are operating under a single company. At the same time, now what the management overall of this company decides is to transfer one of the business to new company and only retain one business in A. So for example, B2, which is perfumes business, is transferred from A Limited to B Limited, and hence the new company B Limited will carry on the business of textiles. So this is also one kind of a merger, right? I mean, not merger per se, but demerger, because here the business or the company has been demerged into another company. Clear? Any questions till now, students? So we call this as a demerger. Again, this is called as a merger, right? Wherein the legal entity is getting dissolved and the company is getting merged into A. This is called as acquisition, right? Wherein the company is taking over majority stake in another company and hence there is a holding subsidiary relationship. And both the companies are operating independently from a legal perspective. And then lastly is the demerger that we have discussed just now, in which one company breaks into two basis, let's say their business division, basis some other thing, basis geography, or basis anything, right? But here we have taken example of business division. Now, on the fourth part, now let's assume there are two different companies, A and B. Both of them gets dissolved and both of them transfer their respective business and a new company emerges as C. This is also called as a merger. This is also one kind of a merger, right? Wherein both the companies are getting dissolved. See, ultimately this happens when? This happens where the where both the companies would not want to continue as a going concern, right? There, wherein they will say that okay, we will form a new company itself, and all of us will transfer all our assets and liabilities to the new company, and the new company will operate in the independent manner, having both the businesses in their purview. Okay, so this is also called as one of the merger. Then fifth part. The fifth part is where we are saying that there are again two companies, company A and company B. Company A is having perfumes, company B is having two different business. One is on the deodorants and second is on the soaps, for example. So company A is already doing business in perfumes, but there's another company which is unrelated, maybe some other company which is in the same line. So one, they are doing the business of deodorant, and second, they are doing the soaps business. Now this is very practical example, because we have seen a lot of cases like this. Now what B decides is that B says that I will continue with the soap business, but I will have to sell off my deodorants business, because deodorants is not our forte and we will not be continuing with this. So now what happens once B decides, so they will venture out for the buyer of the deodorants business. So that buyer is whom? That buyer is, let's say, A Limited, which is already into the business of perfumes. Now here the entire company is not getting transferred. Only a segment, which is deodorant business of B Limited, is getting transferred. So what will B do? B will transfer all the deodorants related assets, right? Now all these assets will be what? The property, plant and equipment, the intangibles, right? Which is the technical know-how, brands, copyrights, all those things, any receivable, any payable. So any receivable, any payable, they will transfer as a assets. I mean, we call this as a net assets. So all these net assets will be transferred by B Limited to A Limited, and A Limited will discharge the purchase consideration. Okay, clear, students? And now A Limited will continue with perfumes and deodorants. However, B will continue with the soaps business. Clear? Any questions, students, till now? These are the 5 different cases that we have discussed.
Clear, sir.
Yeah. Clear? Okay. Perfect. Now, yes, one important point that we have discussed in our earlier session on mergers and acquisition is this is done through a business transfer agreement. So this B Limited will transfer its business to A Limited through a business transfer agreement, which will specify all the terms and conditions upon which this business is getting transferred, right? Now let's take the example, the first case in which B Limited is getting merged with A Limited. So we say that B merges with A, right? And hence A becomes the acquiring company and B becomes the target company, right? Because if I'm targeting any company and I want to purchase it, let's say not only as a going concern, but we want to get it merged into ourselves, so that we will call as a target company in with which we are taking that company, and acquiring company is the one which is into the process of acquisition, right? Now now comes the next thing. We are talking about purchase consideration. Now what do we really mean by purchase consideration, right? Because this is a very important aspect of a merger and acquisition. So purchase consideration can happen in different ways, right? In a layman terms, it is the price that we will pay. Let's say if I go today and buy a asset in the market, okay, for example, I am going to buy a plant and machinery in the market. What is the purchase consideration in this commercial transaction? In this commercial transaction, the purchase consideration is the amount charged by the seller of that plant and machinery to me, and whatever I am paying it to them, it becomes the purchase consideration. Now it has two elements. One, to determine what is that value of that plant and machinery, correct? And second, what is my mode of payment for that value to the supplier? Clear? So now there are two parts, right? One is the value, and second is how I'm going to discharge it. So let's say I'm going to pay through cash, I'm going to pay through a check, I'm going to pay through another asset that I have, let's say a barter one, right? So it can be a number of things, the way I want to pay and the way it is agreed between me and supplier, we will pay that. So the same principle of purchase consideration actually applies whenever we talk about sale and purchase of a company. Now, in this case, let's say that acquiring company, which is A Limited, is going to a target company to purchase that B Limited, right? Now, first question is that what is the right value of B Limited? Correct? What is the right or the correct value of B Limited? The second question is that how is A Limited going to discharge that value to B Limited? Either to B Limited or to the owners of B Limited. Now, if you see, let's first talk about in case it has to be discharged through the issue of equity shares of A Limited. Now, if you see, A Limited is acquiring B Limited, what A Limited will say that, okay, you join, you merge with us and I will issue you my equity shares, right? Which is A Limited's equity shares. So that becomes a consideration, yes, because these can be sold later on by the B Limited's shareholders to whom these A Limited shares have been assigned, and then they can make money. So what is the first type of purchase consideration, the mode that we can settle it? Equity shares of A Limited issued to. Now, can anyone tell me why are we are issuing it to the shareholders of B Limited and not B Limited? We are So we are purchasing the company B Limited, right? So why are we not paying these amounts to B Limited? Why to the why we are not issuing these equity shares to the B Limited? Why are we issuing these equity shares to the shareholders of B Limited? Would anyone want to share their thoughts? Because this is very important aspect.
because they are acquiring the shares of B Limited.
Yes, correct. Because they are already the shareholder and the owner of B Limited. I think Swaminathan also responded through chat, and thanks for the one who responded through voice. So the concern here is if we issue it to B Limited is going to lose its legal identity tomorrow, right? And hence we cannot issue it to B Limited. The owners of B Limited are the ones who are ultimate beneficiary of this transaction, right? Because the owners would have decided to sell the company that they hold, and hence the purchase consideration should also get settled with the owners. Okay, so this is first part. Now the second question, or let's say the second element of a purchase consideration, as I told, that what is the right value? If I'm going to issue you the equity shares, how many equity shares should I issue? What is the right value of that equity shares that I should be issuing the shareholders of B Limited? Okay, what is the right value of the shares that I will be issuing to the shareholders? Now this is called as swap ratio. Why swap ratio? We will have to determine how many equity shares against how many equity shares of B Limited. So how many equity shares of A Limited I will issue against the how many equity shares of B Limited. This is called as swap ratio, because ultimately what we are doing to the shareholders of B Limited, we are telling them that you surrender your shareholding in B Limited to us, and we will issue you our equity shareholders in A Limited. So you are swapping your ownership. You are swapping your ownership to the shares of our company. Okay. Now we will see how to calculate this swap ratio. There are principles of calculating the swap ratio that are discussed later on. Now the second part is actually on the cash payment, right? Which is outflow of the funds. So I mean, this is the most common way, right? Where you go and you outrightly pay the amount. By cash, I don't mean cash, I mean through bank transfers, right? Through outflow of funds, you can go and purchase the B Limited. Now, again, you will be discharging this payment to whom? To the shareholders of B Limited, right? And hence, this becomes the value of the payment. So the second part of the purchase consideration, that how to arrive at the value which we are going to discharge through cash payment, is something that we will discuss. Okay. Even the swap ratio we will discuss, and this also we will be discussing. The third part is actually the combination of both. Okay. It's a combination of both, wherein can be some of the consideration can be through cash payment, some of the consideration can be through equity shares being issued. Now just to give you real life example, students, so if you see, okay, let me add it here. I'm just trying to tell you, just a second, students. Yeah, now the real life example is wherein somewhere I think in 2021/22, Hindustan Unilever Limited HUL have purchased Boost and Horlicks. Okay, these are the two brands, Boost and Horlicks, which was acquired from GSK, GlaxoSmithKline. So they were already holding these two brands as their different business segments. So HUL did not acquire entire GSK; it only acquired Boost and Horlicks. Right? Now, this actually is a case of fifth situation that we discussed, wherein GSK, let's say, is B and HUL is A. So GSK is having different business segments. Out of these, the business segment on Boost and Horlicks is what is getting transferred to HUL, which is A Limited in this case. Now, if interestingly, if you go through their annual reports, you will also see how they have discharged the purchase consideration is discharged through issue of equity shares, which is the first case. Clear? So this purchase consideration is discharged by issuing equity shares. So that means they would have calculated what is the swap ratio, how many equity shares has to be issued, right? So this is the real life example, example number one. Second example, and this is all available in public domain. The information is all available in public domain. They have disclosed in their annual financial statements through which we can refer. Second case is actually on Godrej Consumer Product Limited. So Godrej Consumer Products have again acquired from Raymond's a brand called Park Avenue. Okay. And the moment they acquired it, only I'm saying again, Raymond's would have different businesses, right? Only one segment they have acquired, which is again case number five, this form of merger and acquisition. And this time how they have discharged the purchase consideration through payment of funds slash cash. What I mean to say that they have outrightly paid the amount to Raymond's to acquire this business segment, which is the second type of example, right? So here there was no swap ratio. Here there was no valuation of the acquiring company. The in both the cases they would have done in both the cases they would have done the valuation of the target company, right? Target company business segment that they are going to acquire. For example, Boost and Horlicks, as well as the Park Avenue from Raymond. They would have done the valuation of these segments respectively. Clear? And the third one is really the combination of one and two, which is what we have discussed, right? So I just thought of giving these two real life examples. Yeah. Is there any other items shared to target company other than equity and cash for purchase consideration? See, practically, if you ask me, very less chances that apart from this, if there is anything else, right? Because generally the settlement will happen in this way. There can be situations where you issue convertible equity shares, there can be situations where you issue convertible debt, right? All those things are there, but most commonly used are these two items. Okay. And just to tell you that the possibility of exchanging anything can be there, right? Because commercially there is no legal, there is no legal roadblock not to issue anything, right? Within the realms of the law, or let's say whatever gets even approved in the high court as well, because these schemes of merger demerger gets approved in the court of law, and then only you can accordingly proceed with. So entire law part of this you would be taking up in your different subject, right? What are the processes? How many creditors approve? How many creditors approval is needed? How many debenture holders approval is needed? So all that is covered there. Okay. Now let's come to the value, right? Where we were talking about the swap ratio. So the understanding, or let's say the flow, is very simple, that for calculating anything to be swapped, first of all, we need to know that what is the total value between the two, right? What is the total value between the two? For example, if I have to do a swapping of land with, uh, let's take an example of a land along with a flat. For example, there is a land and there is a flat. We want to purchase a flat and we have land. And hence we will have to exchange that land and flat. So what we will have to do first? The value of that land has to be calculated. The value of that flat has to be calculated. Just a second, students. Yeah. So what I was saying is that we'll have to first calculate both the values, right? And then basis those values, we'll have to arrive at the swap ratio, right? Whatever we are giving up and whatever we are getting, the proportion of that becomes the swap ratio. And lastly, from a merger and acquisition perspective, we will be doing the merger post merger analysis, that whatever we have thought pre merger, whether that is coming out properly or not. Yeah. Then we would also be discussing about, let's say, in this entire thing, P ratio will also play a role. Now, what do we mean by P ratio? P ratio is price by earnings, wherein we say that what is the multiplier on your earnings to arrive at the price. So P ratio is just a multiplier. Let's say if it is 20 times, so that means if you earn 1 rupee, your price should be 20 rupees. Clear? And this is given by MPS divided by EPS. Okay, this is called as PE ratio. Now, how to calculate the swap ratio? Now, there are different ways to calculate swap ratio. Basis the market price, we can simply calculate market price per share of B Limited divided by market price share of A Limited. So by B Limited and A Limited, we mean B Limited is the target company and A Limited is the acquiring company. Okay. Then similarly on EPS, EPS is basically the earnings per share, right? Similar to market price per share, even EPS can be used to calculate the swap ratio. And in this case also, in the numerator, we will have to put earnings per share of B Limited divided by the earnings per share of A Limited. Then I think these two we have added.
So, what is the formula for EPS?
So EPS is okay. Let me show you. EPS is calculated as earnings attributable to the equity shareholders. I am just writing it here. Divided by number of equity shares. Okay, so if you see, even in most of the financials, this EPS has to be disclosed, so that is there. The same formula is also used there. If whatever is my earnings, which is PAT minus any preference dividend, if I'm paying, that becomes the earnings attributable to equity shareholders, and that we divide by the number of equity shares to arrive at the EPS, right? The third basis to calculate swap ratio is the book value per share. Now, the first and second basis is market price per share and earnings per share. So, market price per share is actually market based, as we have mentioned here. So, this is market based, right? This is earnings based, right? And the book value based means basis their balance sheet. Whatever is the value coming out to be as per their balance sheet, so that is reflected in the book value per share. This again, in the numerator, we will take the target company, and in the denominator, we will take the acquiring company. So this, please remember, this is, if you do it reverse, then the entire calculation will go for a toss. Hence, we'll have to be very clear that numerator and denominator, what we are taking. The fourth part is actually basis the, so this is a very specific case for banking industry, right? Because what happens typically in banking industry, there is a term called NPA, which is non-performing asset, wherein you are not able to recover the principal repayments as well as the interest amounts for the loans that you have given. Now, what happens there is that NPA as a percentage to the overall loan is calculated as a part of their balance sheet, as a part of their financials, and it's deemed to be a bad ratio, right? I mean, if higher this number, it would not be a good place to be in. So hence, if you see here, we reverse the order of numerator and denominator. So here we say that if gross NPA is being used, which is a negative metric, so if A Limited is the acquiring company and B Limited is the target company, so the NPA percentage of target company will come in the denominator, and the NPA percentage of the acquiring company will come in the numerator. This is gross NPA based. Because if you assume now, let's say A Limited and B Limited, let's say the gross NPA here is 10% and here it is 20%, right? If you go by your earlier logic, wherein 20% divided by 10%, if you do, that means 2 is to 1. So while acquiring B Limited, which is having a higher NPA, you will not be giving two equity shares against one, right? Because this is wrong. The way to look it as wrong, because I will not be paying two equity shares against one equity share of B Limited just because they're having double the NPA percentage. I will rather be giving half equity share against their one equity share because they are twice as much the NPA as we are. So the right way to look at will be 10 divided by 20%. So which is 0.5 is to 1. So I will be issuing every one equity share against the two equity share that they are holding. So this makes more sense, right? Similarly, on the positive ratios, right, which is MPS, EPS, book value per share, it's a straight formula wherein in the numerator the target company will be there, denominator acquiring company will be there. Students, clear? Any questions till now? So EPS formula here also we have written the earnings attributable to equity shareholders divided by the number of equity shares. Any questions till now, students? Please do let me know. Clear. Okay. Then let's come to the post-merger analysis. So, okay, before we go that, sorry, one more thing. Now, sometimes, now, Now, sometimes the question will say that you will have to calculate the swap ratio basis market price. Sometimes the question will say that you will have to calculate the swap ratio using EPS. Or sometimes it can say that you have to calculate basis BVPS. But there are certain unique questions which will also tell you to calculate the swap ratio through all these three things and assign weights. Let's say it says that 30% weightage will be given to MPS based swap ratio, another 50% weightage will be given to EPS based, and another 20% will be given to book value per share. So, what we will have to do in that case? We will have to calculate the individual swap ratios, multiply with their respective weights, and arrive at an overall weighted swap ratio for that particular business. Okay, so I am keeping it a very open-ended thing by not saying that you restrict always yourself by only one way of calculating the swap ratio. Always look into the question, how question is guiding you to calculate the swap ratio. If the question is silent, if the question is silent, we tend to use the MPS based ratio. Or if let's say the question is silent but the information is only given for EPS, then you can only apply EPS based swap ratio. So it really depends on how the question is framed. Then the EPS, now let's come to the post merger analysis. Now post merger analysis is actually once you decided that this is going to be the swap ratio and you did that merger, and let's say some reasonable amount, let's say 3 months, 4 months, 6 months, 1 year has happened, and now you're trying to analyze that whatever you projected or whatever you thought, whether those things are happening or not. So first of all, for doing that post-merger analysis, we need to know that what is my EPS post-merger. Let's say company B is merging to company A, and we have issued equity shareholders for the settlement, which is the purchase consideration method 1. Okay. So in that case, if I tell you to calculate the EPS post merger, what you will do, you will take the PAT of A, which is profit after tax of A, standalone profit after tax for B, and add them. Then we will also take what is the synergy gain, right? By synergy gain, we mean add. So let's say if the merger has not happened, then both of them would be earning, let's say, whatever they are earning, PAT A and PAT B. But the moment the merger happens, so their earnings will not only be the will be the arithmetic calculation of A and B, it will be beyond that. Just to give you an example. So let's say A and B both are having the top management, the board of directors, the general overheads, they will have a similar corporate setup, right? The moment B loses its legal identity and merges into A, the business generation remains same. However, these all overheads of B limited are not required to be incurred. So that will mean savings of such amounts from A Limited's perspective. The answer is yes. So it will lead to synergy gain. The answer is yes. Another example. Let's say A Limited and B Limited, both of them are connected through a value chain in which B Limited supplies its materials to A Limited. Right? Now, what was happening earlier? B Limited was supplying on a standalone basis to A Limited, and they were both of them were doing part of the process, right? Let's say part of the process was done by B Limited, part of the process is done by A Limited. Now, if we combine both of them, there will be economies of scale, right? There will be economies of scale. Then collectively, the entire process, if comes under one roof, the inefficiencies will go out, right? And this will all lead to better benefit compared to what both of them were making independently, this is also called as synergy gain. So synergy gain will occur because both of them are operating under the same umbrella now, right? Because of this merger, what additional gain is coming, that is called as synergy gain, students. So ultimately, whatever I will earn after the merger will be individual part of A, individual part of B, and the synergy gain. This we are going to divide by the equity shares of A Limited, okay, and the equity shares issued to the shareholders of B Limited. Clear? Because see, these are the existing set of equity shares, students. And to complete this transaction, we have issued basis the swap ratio further equity shares, right, to the shareholders of B Limited. So this is that. And hence we arrive at the earnings per share amount. The second situation is whenever we pay through funds, what is the EPS post merger? We will take part of A, part of B, synergy gain. Till here the situation remains same. Now we will also adjust for the amount that we have paid in cash. See why? Because there are two possibilities through which the purchase consideration would have been paid. Okay, let me come to this to explain this better. Yes. So we said that there is a cash payment outflow of funds that is possible. Now there are two ways the sourcing of this cash can happen. One, I can go and borrow the amounts for making the payment, right, through banks. So one way is this. Second, I have surplus cash through which I will be able to pay for the deal. By I mean A Limited here, right? So A Limited will be sitting on a surplus cash and they will be paying to B Limited for the acquisition, or A Limited will go and take a loan and discharge the consideration. Whichever way A Limited does. See, in the first case where the loan is taken, A Limited will incur interest cost extra. The second case where A Limited is purchasing B Limited through its own surplus. In this case, what is happening? In this case, A Limited will incur an opportunity cost for the funds that has been paid. If those funds would have been invested somewhere else, they would have been able to generate returns, right? In either ways, in one case there is opportunity cost of interest. In second case, there is actual finance cost that we are incurring. So, can we say that once we pay the amount, so I will be left with this much of amount less, whatever I have paid in cash multiplied by return percentage. So this much of amount is kept on a lower amount, okay, and this will be 1 minus t, which is the tax rate adjusted impact, okay, because all of this is post tax. So my overall earnings will go down to the extent that I have paid cash, I have discharged cash through either borrowing or through my own source of funds. And this whole divided by the equity shares of A Limited. Okay. And here we are not adding any further issue. Why? Because they have not been issued. It's only whatever were the equity shares of A Limited earlier are now. I hope this is clear, students. There is one question. Is synergy loss possible? This is from Swaminathan. So synergy loss, definitely, while you anticipate any merger or acquisition, you don't anticipate for that loss. If there is a loss, why will you enter into that deal? Until and unless you are quoting a price, you're quoting a swap ratio after taking into account that loss. You're getting my point. If there is a loss, you will build it into your offer that you are making for purchase value. Clear? But practically, generally, if there are losses, then the deal will happen at a very low prices so that it's compensated in the deal value. Okay. At the same time, it is also important to understand that see synergy gain or synergy loss, whatever that estimation is, that is still an estimation before we enter into the deal. Post facto, it is very important to see how are these numbers and what is the overall impact, and hence post merger analysis is very very important. That's what we are discussing. Now, this is what synergy that we have discussed. The value of A and B, which is the combined entity, is always greater than the arithmetical summation of independent values of A and B. So here we have, let's say, what all factors will contribute to the synergy. The board of directors, the common management, the supervisory layer, overheads, support functions. So all of these for B Limited now will not be required because entire oversight will happen within A Limited. Hence, their individual combined profitability is lower than the merged entity's profitability, is what we are saying. And this is the difference is called as the synergy. Now, the question will tell you to calculate the effect on EPS post merger. Okay. Till now, what we have calculated, we have calculated the EPS post merger. Now, the question will also say that you have to calculate what is the effect on EPS post merger. So, here we'll have to see it from two lenses. One is from the acquiring company, and second one is the target company. Okay. So, A Limited, which is the acquiring company, if we have to calculate the impact of EPS on them, then what we will do? First of all, we will see that what is the post-merger EPS, right? The ways we have discussed above, this one and that one. What is the post-merger EPS? And from that, we will be reducing the pre-merger EPS. Simple, because the dilution has happened for A Limited, wherein earlier there were fewer number of equity shares, but now we have issued more equity shares to the target company, right? So there is a dilution that has happened. But at the same time, there is an addition of the profit also that has happened in the numerator we saw, right? Part of A and part of B and synergy, right? So in a way, just to see that then what is the EPS per share impact, what it is coming out to be will be calculated through this. So suppose it is 10, suppose it is 8, so 2 will become the net impact on the EPS of the acquirer company. So that means by 2 rupees per share, the EPS has gone up. Clear? Any doubt till now, students?
No, sir.
Perfect. Then the target company, this is tricky one. Now post-merger EPS of A Limited. Now students, please note, there is no B Limited post-merger because B Limited, the identity has been dissolved. There is no legal identity of B Limited. Now what is happening? The post-merger EPS of A Limited will have to take, and that we will have to adjust for the swap ratio to arrive at the like-to-like value of B Limited. Clear? So this is adjusted for swap ratio. From this, we will reduce the pre-merger EPS of B Limited. So, students, see, I think here we have mentioned also one share of A Limited post merger is not equal to one share of B Limited pre merger. However, in the above case, one share of pre merger A Limited is equal to one share of post merger A Limited. Correct. But here that is not the case because B Limited shares were multiplied with the swap ratio to arrive at the new number of A Limited's equity share. So while we will have to go back and compare it with the B Limited's share pre-merger, then we will take the A Limited shares and we will again adjust it for the swap ratio to arrive at the like-to-like comparison. Clear? So this is a very catching point which we
So
need to remember.
this
Yes,
is not clear, sir. This part.
this part is not clear. Okay, let me do one thing. Let me again explain it. So let's assume the swap ratio is 2 is to 1. Okay. So swap ratio 2 is to 1 means 2 share of A Limited will be issued for 1 share of B Limited. Clear? So let's say it is 2 is to 1 and this is the meaning of the swap ratio. Now, the B Limited shares were 10,000. So that means you would have issued 20,000 shares of A Limited. Correct? You would have issued 20,000 shares of A Limited. And I
Yes.
am also, sorry,
Yes, sir.
yeah, and I am also telling you that the EPS of B Limited is, let's say, 5 rupees, and post merger EPS of A Limited is, let's say, 7 rupees. Okay. Now, if I tell you that from B Limited's perspective, what is the effect on EPS? So what we cannot say it is 7 minus 5, right? Because 7 is the basis the A Limited's new issue of 20,000. This is 7 that is coming, and 5 was basis the standalone number. So what we will do? We will take, just a second. Sorry, just a second. There is this. Yeah. Just a second. This is hand actually. So what we will do, we will take the post merger EPS of A Limited, which is 7 rupees, and this will be adjusted for the swap ratio, which is 2 is to 1, right? So we will take this as 14 minus pre-merger EPS of B Limited is actually 5. So net impact is 9 rupees
Yes.
because one share of B Limited was equivalent to 2 shares of A Limited. That's where we have taken the adjustment of swap ratio. Okay, clear?
Yes.
Swami Nathan is saying if swap ratio is 1 is to 1, then no change required. Yes, you're right. If the swap ratio is 1 is to 1, then it's not required to be adjusted. Okay, perfect.
But we'll have to show that calculation, huh, sir? Right? That, yeah, or we'll have to simply write that we are not adjusting because the ratio is 1:1.
We can simply say like this only, that into 1:1 here,
Yes. Yes.
post the EPS of A limited into 1:1, which is 7 only it will come, and hence we can write. Okay. Now, there is an important term called value of acquisition. In lot of questions, you will be asked about that. What is the value of acquisition? Now, value of acquisition can be different from different perspectives, right? If, I mean, acquisition, since it is done from A limited side, we are trying to discuss it from A limited's perspective. Okay. What will it be? The value of merged entity minus the value of acquiring company before merger. So the idea is very simple, that what is your revised value, what is your revised market value post merger? The A limiteds, that means, because A limited is where the merging has happened. And what was it before merger? The same A limited before merger, what was the value? Now, for example, if I've given you, okay, now I would want all of you to, yeah, this is A limited. This is again A limited. This is pre-merger and this is post-merger. Okay. Now, in case of pre-merger, EPS was given as, let's say, 10 rupees. In the post one, it has become 15 rupees. Okay. If we have to arrive at MPS, what additional information should I give so that we can arrive at MPS? Come on, students. The market price per share, A limited pre-merger and post-merger. If I have to calculate these values, if you are already given EPS, what should I give you extra so that we can arrive at MPS?
PE ratio.
Very good. PE ratio. The moment I'll tell you that this is the PE ratio pre-merger and post-merger, I think we will be able to arrive at the MPS. Simple. Now let's say PE ratio pre-merger was 5 times and here it becomes 6 times. So the value will become 50, MPS will become 50 here, and here it will be 90. Correct? So if you multiply it with the number of shares, this is again pre-merger and post-merger. Let's say pre-merger were 1 lakh shares, post-merger it became, let's say, 2 lakh shares, right? So ultimately, the pre-merger value, how will you arrive at the value of the company? You will just take the market price per share multiplied with the number of shares. So here it will be 50 lakhs. Here it will be 1.8 crores, right? So if you see, this is the value of the company post merger, this is the value of the company pre merger. So if I may tell you that what is the value of your acquisition? What is the value of your acquisition? From a market perspective, you will say that, see, earlier the value of the company was 50 lakhs, now it is 1.8 crores. That means 1.3 crore is the value of acquisition, right? Because ultimately it has added to the market capitalization of the company in which the merger has happened. Clear? So the value of acquisition, hence it will become 1.80 CR minus 50 lakhs. Clear? The question will also ask you that calculate the gain or loss to the shareholders. See, because ultimately the ultimate beneficiary of this entire deal, whether you talk about A limited, whether you talk about B limited, are the shareholders, right? The moment we are issuing shares to B limited, A limited shareholders are the beneficiaries. The moment we are issuing equity shares, or let's say the moment we are overtaking the assets and liabilities of B limited, A Limited shareholders are the beneficiaries, right? Because now their net assets value has increased. So how to calculate whether who has gained what and who has lost what? So if we talk about again from the A Limited's perspective, it is very simple, right? One share A Limited pre-merger is equal to one share post-merger of A Limited, right? So that 1:1 is maintained at least for A Limited. So what we will do, we will just take the simply market price per share of post-merger A Limited and market price per share of pre-merger A Limited. Let's say it was 100 here, it was 80 here, so 20 rupees is the gain, right? That's how a shareholder will typically do. Shareholder will say that before merger my price was appearing as 80, now it is appearing as 100 in the market. My holding has not changed. Whatever I was holding earlier is the same number I am holding now, and hence the ratio is 1:1 only for A Limited. So 20 rupees I am gaining, right? It can be reverse also. Maybe 80 and 100. So that means 20 rupees will become your loss. It can happen. So let's say if I have purchased a target company at a very high value compared to what I am getting, so this can be the case. So in that case, I can become a loser, right? In terms of the entire deal. So hence, what we'll have to do? Will have to assess, and hence it is very important from the post merger analysis perspective, the one that I was talking about. We'll have to always assess that in terms of EPS are we gaining or not, in terms of MPS are we gaining or not, and hence the post merger analysis becomes really very important. Then let's talk about the gain or loss to the shareholders from B Limited's perspective. Now before reading this, now, would anyone would want to attempt based on the same principle that we have discussed, that can I take simply MPS post merger of A Limited and I can reduce MPS pre merger of B Limited. Is this looking fine to all of you, or is there some change required here?
Some change is required.
And what will be that change?
Swap ratio adjustment.
Very good. So it has to be adjusted for the swap ratio. And the reason why we need to adjust the swap ratio here? So the reason why we need to adjust the swap ratio is because pre-merger B Limited 1 share is not equal to post-merger A Limited 1 share, right? Both of them are linked through swap ratio. So MPS of post-merger A Limited adjusted for swap ratio minus MPS of pre-merger B Limited, which is contributing to the gain or loss. Clear? So this aspect is also very much important, that from the target company, from the acquiring company, who all is gaining or losing what. Clear, students? Any questions, any doubts till now? I hope all of us are able to understand what we are doing and why we are doing. Okay. Perfect. Now let's come to the market capitalization. I think market capitalization is a topic that is not specific to this. I mean, to not specific to this topic itself. I mean, it's a general topic, right? We all know how to calculate the market capitalization. It's simply the market price per share multiplied by the number of equity shares, right? So this market cap means that what is the value of that company within the market. Then comes the concept of promoter holding. What do we mean by promoters holding? Promoters holding is the percentage of the overall market cap which is held by the promoters. Now, who are promoters? Promoters are basically the shareholders, the first shareholders of the company who gets the company incorporated. They are actually the ones, they are the initial lot of people who are involved in getting the company incorporated, getting the business, the initial part of the things done, setting up of the entire company. So they are called as promoters. So whatever holding they are carrying is called as the promoter holding. Now, if their holding is called as the promoter holding, there is a concept called as free float market cap. So, free float market capitalization really means the amount of market capitalization which is not held by the promoters. Okay, so which is 1 minus X percent. Then comes the true cost of merger. So, the true cost of merger is basically whatever gain is happening to the shareholders of B Limited, that becomes the true cost of merger. Yes, it can be because of synergy gain. You're right, Swaminathan. But if you really understand that, in this entire game, in this entire deal, if A Limited is gaining, then B Limited is losing. If B Limited is gaining, then A Limited is losing, right? Because both of them are fixing a value of the respective business and they are executing the deal basis those values. Now, true cost of merger, although it is a gain to the shareholders of B Limited, but this is a cost incurred by A Limited. Because whatever gain has happened to B Limited, that means that is going out of A Limited's values, right? Then value of the merger is basically whatever the gain to the shareholders of A Limited has happened. This is from the acquiring company, right? So that is the real value of the merger. Yeah. So if swap ratio is 1 is to 2, then loss for the acquiring company. No, it will not be, right, because see, the swap ratio can be anything. So swap ratio will not determine whether you are on a losing side or on a winning side, right? Swap ratio typically is just a relationship between what number of shares are to be issued. The real gain or loss will come once you multiply these values and compare it with pre and post, right? Multiply these values with their earnings per share, with their market price per share, right? So that will really determine that whether you are at a losing stage or a winning stage. Okay. Now, this example we discussed about two different companies. One is the HDFC Bank and second is the Reliance. So HDFC Bank, if you see, the market capitalization is around 165 billion, and Reliance it was 200 billion. Now, if you see the free float market cap, Reliance as a group, around 50% is held by promoters. So the free float market cap is only 100 billion. But HDFC as a group, only 10% is held by the promoters. So although, so the what parallels we are trying to draw from here is that although the market cap of HDFC Bank is lower than the market cap of Reliance, but the free float market cap HDFC would be higher than Reliance. And students, let me tell you, from a practical perspective, what does really matters is the free float, right? Because within that free float market cap itself, you are free to take the operational decisions. It will not be so. This promoter holding is on a long term basis, right? Balance 50% will keep on buying and selling between the sellers. Similarly for here as well. So that was a news at that point of time that although HDFC's market cap is lower, but their free float market cap is higher. Then came the questions. So these questions are very much on the similar lines that we discussed. We'll cover the concepts and then we'll see some of the questions that we can pick. Which is the free float market capitalization, low or high? No, no. The see, it's not about the advantage, it's about the comparability between two companies, right? So what I'm trying to say is you cannot compare two different companies only by the way of market cap. You will also need to see that what is their free float market cap, right? Obviously, the company which is having higher market cap, the company which is having higher, market cap itself will be on a better side because that will be a stronger company. But at the same time, we also need to know that how much percentage of holding is held by whom. Where were we? Where were we? Yeah, we were saying that some of the questions we will discuss. Question number 7, 8.
Sir, is this PDF shared, sir? This particular one?
So I think this is part of the recorded sessions that would have been hosted earlier. Let me check whether the specific PDF has been shared or not. Okay? But the content that we're covering is already part of the recorded session. Okay.
Okay.
I think there are no from a question standpoint. Okay, let's see this question. We'll cover the balance concepts also, but let's see this question. So question number 12, it says Elron Limited plans to acquire Doom Limited. Okay, so it's an acquisition. The relevant financial details of the two firms prior to the merger announcement are very nice. We have been given the details pre-merger, which is their market price per share respectively 50 and 25. The number of outstanding shares is 20 lakhs and 10 lakhs. The merger is expected to generate gains which has a present value of 200 lakhs. What is this, students? This is synergy, right? Very, very good. Yes, Swaminathan. The exchange ratio is agreed to is 0.5. If this would have not been given to you, can you calculate the exchange ratio here? For a moment, if this is not given to you, then can you calculate the exchange ratio? The answer is yes. We will do MPS divided by MPS. MPS of Doom Limited, which is B Limited equivalent, the target company, divided by Elrond Limited. Clear? So it becomes 25 by 50, which is 0.5 is to 1. The same ratio that they have also agreed for. What is the true cost of the merger from the point of view of Elron Limited? Now, this question is specifying very clearly that what is the true cost of merger from the point of view of the acquiring company, right? Which is the Dooms Limited. So let's see. For that, we'll have to calculate the pre and post values, right? So shares to be issued to Dooms Limited is how much? If they're already having 10 lakhs, zero point 0.5 shares will be issued. So that means 5 lakh shares will be issued to them. The percentage of Doom Limited in the overall capital will become how much? So it will become 5 lakh divided by 20. plus 5, right? Because 20 was the existing shares and 5 is what they have arrived at new. So overall holding of Doom Limited's shareholder in the new setup post merger becomes 20%. Now, value of the company post merger will become what? 50 into 20 lakhs, 25 into 10 lakhs, and synergy gain of 200 lakhs. Right? These are the standalone values of A, value of B, and synergy gain. Now, this entirely will give us the number or the value of the business as 1450 lakhs. 80% of this goes to Elrond and 20% of this goes to Doom. Clear? The 20% of 1450 will become how much?
290.
And perfect. And 25 into 10 lakhs, whatever was their existing amount. So 290 minus 250. So that means 40 is the gain that is enjoyed by the shareholders of Doom Limited, right? Because they have given a value of 250. So please understand, shareholders, this is of Doom Limited, and let's say this is Elrond Limited. Now, in this entire transaction, if you see what has happened, the shareholders have given up a value of 250 lakhs, right? And what they have got shares in return and the stake, 20% stake in Elrond Limited, which translates into 290 lakhs, right? So ultimately, 40 is the cost from this side and gain from this side. This was I was trying to explain that in this entire cycle, one's gain is another's loss. Any question, students? I hope this is clear. Okay. Question number 13. Let's take this question as well, and then we will take up the other concepts, the remaining concepts. So MK Limited is considering acquiring NL Limited. The following information is available. MK Limited, earnings after tax, number of equity shares, and market value per share, all the three elements are given. Similarly, NL Limited, the information is given. Exchange of equity shares for acquisition is based on the current market values. Simple. It is based on the current market values. There is no synergy advantage available. This also has been specified. Find the earnings per share for the company MK after merger and find the exchange ratio so that shareholders of NL Limited will not be at a loss. So this is a tricky one. The below is a tricky one. Let's first see what is the swap ratio. Simple, students. Which one is the target company? NL Limited. Which one is the acquiring company? MK Limited. So 160 divided by 200. So 160 divided by 200, that means 0.8 is to 1 becomes the swap ratio. Number of shares to be issued. How many shares are there? 3 lakh. Swap ratio is 0.8. So that means 2,40,000 shares has to be issued. Right? The total shares post merger will become how much? 18 lakh plus 2,40,000. Sorry, this is earnings. 12 lakh plus 2,40,000. 14,40,000 becomes the total number of shares. Similarly, total earnings. How much the total earnings will be? The standalone earnings put together, which is 78 lakhs. So EPS post merger will be 78 divided by 1440, which becomes 5.42 per share. So this becomes the EPS post merger. Then the second part is basically the now, okay, if you see, find the exchange ratio so that shareholders of NL Limited will not be at loss, right? So this will happen how? Can we arrive at the EPS of MK and NL Limited? So this is what 60 by 12 is 5 and 18 by 3 is 6, right? So if you determine the swap ratio basis the EPS, don't you think NN Limited will be at a higher position? Yes, because NN Limited's EPS is higher and hence they will be able to demand more swap ratio compared to the market price per share, because market price per share NN Limited is at a lower rate. There is a question to all of you students, why will it be? Why a lower EPS will be resulting into higher MPS? Why a higher EPS will be resulting into lower MPS? Come on, students, tell me. First of all, we are saying why it will happen. Why it will happen. Can anyone attempt? So it will happen because both of them will have different PE ratios. The P ratio of NL now, okay, can anyone tell me which one will have a higher or better P ratio, MK or NN? So MK's P ratio will be better or NN's P ratio will be better, students? Come on, tell me. Mhm. So it will be MK's P ratio, it will be better, students, because for a lower EPS, we are able to turn it into higher MPS. And we can apply the formula as well, right? 200 divided by 5 is greater than 160 divided by 6, right? If you calculate this, you'll be able to see. So this is because of the PE ratio, the EPS and MPS, the difference is coming. The first part of the question, they are telling us to only focus on MPS. But as a shareholder of NN Limited, I should also say that the swap ratio should be calculated basis the EPS, because that is where I am having a better hand compared to MK Limited. So exchange ratio basis EPS is 6 is to 5, right? 6 is the EPS of NN Limited and 5 is the EPS of MK Limited. Correct? So the number of shares to be issued by MK Limited is 6 is to 5 on 3 lakhs, around 3,60,000 shares. Now you see, in the first case, only 2,40,000 shares were being issued. Now here 3,60,000 shares are being issued. And the EPS after merger will be the overall value divided by this. So that means 5. Correct? So this is the EPS after merger. So EPS for NN Limited shareholder post merger will be 5 into adjusted for the EPS ratio. So this again becomes 6. So what have we arrived at? The post merger EPS and the pre merger EPS for NN Limited shareholders remains same, which is at 6. Clear, students? So the post-merger and pre-merger EPS is same. This adjusted for the swap ratio and the previous one taking as is. So this remains same, and hence this there is no loss from the point of view of these shareholders of NL Limited. I hope this is clear. The viewpoint is clear here. Okay. So students, now let's break for 10 minutes. Let's again reconvene at 8:35. Let's move ahead. So we have reached till question number 13 we just saw. Let me go back there quickly. So, yeah, this is again the questions. Let me first cover the concepts once. 16th, then 17th. Yes. 18th. Yeah. So one question, this is an important one. So let's discuss this question and we will be able to discuss the concept of demerger from this itself. Okay. So let's start, students, on this question number 19 because we have enough conversations on once it comes to merger, then what will be the pre, post, swap ratio, all those things. So this specific question is on the demerger. The following information is relating to Fortune India Limited having two divisions, Viz Pharma division and Fast Moving Consumer Goods division. So Fortune India Limited has two divisions, okay, Pharma and FMCG. Paid up share capital of Fortune India Limited is consisting of 3 lakh equity shares of rupee 1 each. Just a second for the better. Yeah, I hope this will be better now. So the paid up share capital of Fortune India Limited is consisting of 3 lakh equity shares of rupee 1 each. Fortune India Limited decided to demerge Pharma division of Fortune Pharma as Fortune Pharma Limited with effect from 1st of April 2009. Details of Fortune India Limited as on 31st of March 2009 and of Fortune Pharma as on 1st of April 2009 are given as below. So they have given you the new companies taken over assets and liabilities, the old company which was a merged companies, the overall assets and liabilities. The point to remember here is that this is before demerger, this is after demerger. But after demerger, only one leg is given. The Fortune India Limited, which remained as a company, that information is not given. The loans, unsecured, secured, current liabilities, and provisions, these are given. Assets, fixed assets, investment, current assets, loans, and deferred tax miscellaneous expenses also given. Board of directors of the company have decided to issue necessary equity shares of Fortune Pharma Limited. Okay, of rupee 1 each without any consideration to the shareholders of Fortune India Limited. For that purpose, the following points to be considered. Now, this demerger is getting settled through the issue of equity shares, right, of the new company. Clear? The new company's equity shares are being issued to the shareholders of the old company. For that purpose, the following points are considered: transfer of liabilities and assets at book value, which is fine. Estimated profit for the year, for the next year, they are saying is 11,400 lakhs for Fortune India Limited and 1470 lakhs for Fortune Pharma Limited. Estimated market price of Fortune Pharma is 24.50 per share. Average P ratio of FMCG sector is 42 and pharma sector is 25, which is expected for both the companies. Calculate the ratio in which the shares of Fortune Pharma are to be issued to the shareholders of Fortune India. So let's start with this. So students, this is just a depiction of what is happening. Fortune India Limited is a single company. For the sake of simplicity, let's assume 1000 and 200 crore is the separate valuation for different segments. Overall, it's 1200 crore. So FMCG is having a higher valuation, pharma is having a lower valuation. Now, what this company is doing, they are actually moving out these assets of pharma, the net assets of pharma to a new company, right, which is called as Fortune Pharma. And Fortune Pharma now will issue shares to the shareholder of Fortune India Limited, right? So Fortune India Limited will give away the assets and liabilities to Fortune Pharma, and in return, Fortune Pharma will issue shares to the shareholders of Fortune India. The situation is clear till now? Perfect. Now, Fortune India Limited is having 3,000 lakhs number of shares. Fortune Pharma, we have been given the expected price and the PE ratio. Basis this, can we arrive at the EPS? The answer is yes. Can we arrive at the EPS? So the EPS, sorry, the way Fortune Pharma EPS will work is MPS divided by PE ratio. We will arrive at the EPS. The profit for the year is this much. So that means the number of shares we can calculate. The answer is yes. We have been given that for the next year, the profit is estimated to be 1470 lakhs. If the EPS is 0.98 per share and your overall profit is 1470, then we can calculate the number of shares just by dividing the profits divided by the EPS. Hence, the ratio is 0.5 is to 1 for Fortune Pharma for one share of Fortune India, which is the fact, right? 1500 divided by 3000 shares. So, this is the first part, easy and simple, the ratio in which Fortune Pharma are to be issued to the shareholders of Fortune India Limited. Expected market price of Fortune India FMCG Limited. Now they are saying the remaining company after the demerger, what is the expected market price? Are we given the PE ratio? Yes. Can we calculate the EPS? The answer is yes. Multiply EPS with the PE ratio to arrive at the value of the demerged company. Expected market price. So estimated profit is 11,400. The number of shares will remain same of Fortune India Limited. Now students, please note, if this was a case of regular merger that we have discussed, post merger these shares would have changed. But here it is not changing because it is a case of demerger. And in case of a demerger, the new company itself is issuing the fresh equity shares. The EPS becomes 3.8, which is 11,400 divided by 3,000. And the estimated PE is actually 42. So the market price per share is 3.8 into 42, which is 159.60 per share. Clear? So see, this is the beauty of PE ratio. It is always helping you to find the missing link. Sometimes the missing link is earnings per share. Sometimes the missing link is market price per share. Right? Then the third part, book value per share of both companies immediately after demerger. Now for that, we already have the post demerger balances of Fortune Pharma Limited. At the same time, we also need to have what is the post demerger value of Fortune India Limited. Correct? Now, how can we calculate that, students? Come on. Can anyone take a clue from what it is given? How can we arrive at Fortune India, which is the FMCG business division left as on 1/4/2009? How can we arrive at these values? Come on, students, tell me. Any clue from the question? To arrive at the book value per share, we need to know what are the net assets of this as on 1st of April. Come on, students. Whatever you think, you can respond. So Pharma Limited is already there. Swaminathan, Pharma Limited is already there, right? Fortune Pharma Limited, it is already there. Fortune India Limited before demerger, it's already there. I'm saying Fortune India Limited post demerger, how can we calculate? Have you noticed the dates? 31st of March 2009 and 1st of April 2009. The dates are same, right? The dates are, I mean, one after the other. So, can we just simply reduce the overall value of the assets to what has been demerged to arrive at the balance values? Correct? Can we say 3000 minus 400 will become the secured loans of this balance company? Yes. So we will just do take a difference between the two values, students. So book value for A, B, which is Fortune India before demerger, Fortune Pharma after demerger, and Fortune India after demerger. So this is the FMCG part. Okay. So the assets were how much? 70,000. The total assets we take minus total these assets to arrive at the value. Similarly for liabilities, the difference between these two, the book value will be assets minus liabilities and the difference thereupon. So the book value per share. Now for this 3000 lakhs, this also 3000 lakh shares, here it is 1500 lakhs. We arrive at the book value per share, it becomes 15, 14 and 8, students. There is some issue with the scrolling down of the screen. It's not working as desired. I hope this question number 19 is clear, students. So this is a very unique question on demerger, right? A very important one. Yes, is there some question?
So this last calculation, can you please repeat this last one? Book
Okay.
value.
Yes, yes, I will do that. So the third part, if you see, it asks you to calculate what is the book value per share of both the companies immediately after demerger, right? In our example, in this question, what we are saying is Fortune India Limited FMCG segment is still continuing within Fortune India Limited, but Pharma is become a new company called as Fortune Pharma Limited, right? Now the book value will be arrived only once we know that what is the Fortune India FMCG Limited's balance sheet, right? Because pharma we already have and the total we already have. So total value we have and pharma we have. We just have to arrive at the FMCG. So that's what we have done. In this below case, we have just taken before demerger what is the total value of the assets, what is the total value of the assets after demerger for Fortune Pharma. The difference between these two will give us the FMCG assets,
Okay.
right?
Yes.
Similarly for liabilities.
Yes.
Okay. So this is that question on banks specifically, wherein the only catching point here, which we already kind of discussed, is the NPA bit, right? The gross NPA percentage is given for these banks. While calculating the swap ratio basis, the gross NPA percentage, we will have to take into account the uh, the numerator and denominator considerations that we discussed, right? So the numerator,
It will be reversed.
yes, it will be reversed. So yeah, this is what we have discussed, that it will not be 40 by 5, it will be 5 by 40. Okay. Yes. Now let's come to the next topic of rationale for mergers and acquisitions, students. Now the question might come that why there is a need for a merger or acquisition, or what is the supporting logic for a merger or acquisition. Now, in this example, the two examples that I have shared earlier in the session, one on HUL acquiring Boost and Horlicks, and second, Godrej Consumers acquiring Park Avenue from Raymond's. In both the cases, the intent or the rationale for the deal would have been, see, the target company would be clear that they would not want to pursue those business segments because they would not be in line with their philosophy to do whatever they are doing, right? Because if I decide to sell, I mean, there are only two possibilities, right? One, I need liquidity, I need cash, and hence I'm disposing of one line of my business. And the second thought will be that it is not in congruence to what my overall objective of driving the business is. Now, if we come to the rationale from the point of view of purchaser or the acquiring company, here the rationale lies that they see these potential businesses as the, let's say, as the ones that they will integrate within themselves, and maybe they will be able to increase their market share, right? Or maybe they will be able to enter into these categories without much hassles to set it up, right? So all those things will come. The first and the foremost rationale is synergy. This is what we have discussed already, right? Wherein we say that the combined entity value is greater than the individual values of company A and company B, right? Which is A Limited and B Limited. This we have already discussed. Now, lot of factors contributes to this: economies of scale, brands collections, brand allocations, even for that matter, the top management, the overheads reduction, right? All those things comes into the play. Second is diversification. So while going through, I think, portfolio management as well, we understood the concept of diversification. So diversification is the concept where you kind of diversify the investments so that you reduce the unsystematic risk. Remember, there were two types of risk, right? One is systematic risk and second one is unsystematic risk. Systematic risk was the risk due to the system, due to the economy. Unsystematic risk is the risk which is managed at a micro level, right? Which is specific to that company, which is not because of the system. So, those risks that we want to eliminate through diversification, those are only the unsystematic risk. Now, for example, A and B, let's say A is already a company into FMCG business. Now, to diversify, they are also getting into the real estate business. They want to acquire a company which is undergoing the real estate business. So, this will help in getting the diversification objectives met. So why are they doing the mergers and acquisitions? To diversify, right? To enter into a line of business which is totally unrelated and separate. So that tomorrow, if FMCG business fails, the real estate business will go on. Or if real estate business fails, the FMCG business will still go on because both of them are unrelated. One will not impact the other. Third, taxation. Now, students, I think all of you would know or would have studied or would be studying in your direct taxes is there are certain conditions which will allow you to take ahead the benefit of the unabsorbed losses appearing in one of the company. Now, let's take an example of a company which is a very weak company. They have been incurring losses and there is no line of sight by when they will turn profitable. In their income tax returns, they have been claiming such losses and they have built up the amounts for such losses in their income tax returns, which they are allowed to carry forward. Now, the M&A proposition here it is that a strong company which is having profits will take over the weak company, right, which is having accumulated losses. And after it takes over, the unadjusted brought forward tax losses will be adjusted and set off against the future profits of strong company, and they will be able to save tax around the same. This is around taxation, right? This is another principle why they will be uh, they will be interested to undergo the M&A, right? Maybe a strong company can acquire a weak company. Then comes growth. Now, students, this is a very important thing for all of you to understand. There are two kinds of growth. One is organic growth, second is inorganic growth. Organic growth is the one wherein you are responsible to grow basis the specific baselining, right? For example, today we are already having 100 crore of business, 100 crore of sales. So the organic growth will be that on that 100 crore, how much you are able to sell more, let's say 10%. So that becomes 110. With the same set of outlets, with the same set of products, how much you are able to organically grow. Second is inorganic growth. Inorganic growth are such growths which are coming not because of the base, it is coming because of some of the acquisition. Now, let's say in this example, there is a acquisition of a company which is having a 600 crore of revenue. So while before acquisition it was 1000 crore, after acquisition 1000 crore became 1100 crore because of the organic growth, which is 10%. Another 600 crore got added because of the acquisition that we did. Because once you acquire, their future revenues will become part of the overall this thing. So the overall it will be 1700 crore. Out of that, 600 crore will become your inorganic growth, and 100 crore will become your organic growth, students. Right? And these are very important terminologies that you will be seeing in your practical life as well. Whenever you go through any M&A, let's say kind of disclosures, any M&A kind of you know the PPTs or decks, you will find all these terms very much being there. So students, till now we have discussed four rationale for mergers and acquisition. The first one is synergy, the second one is diversification, the third one is taxation, the fourth one is growth. The next one is consolidation of production capacities and increasing market power. Now, what happens? Let's take an example wherein A Limited is having a 60% market share of some particular product. B Limited at the same time is having 10% market share. Okay. B Limited is also having 10% market share within the same industry. Now, consolidation of market power will mean that if B Limited merges with A Limited, both of them collectively will hold 70% of the market, right? So they will have a 70% of the market share. This is what really becomes the rationale for merger and acquisition. Now, production capacities. Let's say A Limited's production capacity is installed at X volume and B Limited's production capacity is installed at Y volumes, right? Both of them belong to the similar industry. Now they might be expecting that in future their production capacities individually will not be sufficient. So what they will do, they will combine, they will merge into themselves and they will combine on their production capacities, right? So this also becomes one of the rationals. Now the types and the forms of mergers and acquisition, students. So this is also important one. So what are the different types and forms? So, if you remember, we discussed initially the five different situations, right? Wherein A limited and B limited is merging. Second, it was acquisition through buying the majority stake. Third was a demerger, right? Similarly, like that. Fourth was a creation of a new company, A plus B becomes C. And fifth one was the transfer of a specific business. Okay. Now, but if somebody asks that what is the types or the forms of the merger, so those are first one, the horizontal merger. So horizontal merger means, as the line suggests, horizontal will be that within the same industry, if A limited and B limited of both of them are within the same industry, the collection of companies having common set of consumers with common needs. This is called as industry, right? So can I say that FMCG is an industry? The answer is yes. Can I say that pharma is an industry? The answer is yes. Because they have common set of consumers with common needs, right? What they expect to consume is common. That is where the industry comes in. So A limited and B limited, both of them are part of the same industry, and if both of them merge, that is called as horizontal merger. Vertical merger, students. Vertical merger is a merger wherein they are part of the same value chain. For example, B limited supplies to A limited and A limited supplies to C limited, right? It's a chain. Now, if we talk about A limited, if it merges C limited with itself, sorry, this will be called as the forward integration because I am merging a customer with me. The backward integration is wherein B limited will merge into A limited, right? So I am integrating my vendors with me. That means I am asking my vendor to merge with me so that we have a robust supply chain. I am asking my customer to merge with me so that I can properly sell and distribute my products. Right? So this is called as vertical merger because they are part of the same value chain. This is coming under the buyer-seller relationship. Okay. Then coming to the conglomerate merger. Conglomerate merger is where both A limited and B limited are totally unrelated, right? Because of the nature of the businesses. But if they decide to merge, but why will they merge if they are unrelated, students? Come on, tell me. We just now discussed. What will be the rationale of merger in case these two businesses are unrelated? Yes, very good, Swaminathan. It's because of diversification. So, diversification will lead to their merger, and hence, the nature of business is still remain unrelated, and hence it is a conglomerate merger. Then comes the co-generic merger. Co-generic merger is a merger which has the same generation. I mean, by generation means same genre, right? I think all of you would have heard this word genre. Genre means commonalities between, let's say, their industries, or there are some factors that are common. Let's say some of the technologies they're using, some of the distribution channel using which they distribute, the product line is similar, right? So all these things results into co-generic merger. In this, we have taken an example of two different NBFCs, non-banking financial corporations. One is into the auto loans and second one is into the credit cards. So the auto loans and the credit cards, both of them are operating under commonalities. What are they? They might have different consumers, but they are part of the same industry of giving credits. Distribution channel is also, let's say, through agents, and the product line is also very much similar. So if both of them merges, that is called as co-generic merger. Yeah, without common customer, because the customer can be different, right? The ones who need auto loans will not be the same who will need the credit cards. So we are saying still they have these three things in common, right? And hence they can be co-generic merger. Now, students, if you see, this is not a horizontal merger as such, right? Because both of them belong to the different industry, right? Or different sub-industry. It's not a horizontal merger, it's not a vertical merger, it's not even a conglomerate merger, it's only a co-generic merger. Then comes reverse merger. Let me check for questions. Yes, so I think Swaminathan we discussed without comment. Yeah, there is nothing as of now in terms of the questions. Yeah, the reverse merger, students. Reverse merger is the merger wherein the smaller company takes over a bigger company, right? See, the general precedence is the larger company will take over or smaller company will merge into the larger company, right? That's what the point is. But in case of a reverse merger, the smaller company will be taking over the larger company. How? This larger company may be a listed company and they will be under losses, accumulated losses, etc. will be there previously. They are approached by a private company, which is a smaller company. So, what they will do, they will buy out this company, right, in such a way that they will get listed. So, this private company, once they buy them, so they buy in such a manner that their shares automatically get listed because the public company shares were listed. So, that's why this is called as a reverse merger. Acquisition is the one where you purchase the majority stake or you control the board of directors. If you control the set of board of directors, that means you are having the acquisition scenario with you. Not only majority stake, but control over the decision making because board of directors are the ultimate decision making authorities, right? Divestiture. So divestiture is a separate topic in which we are actually selling the business, selling the undertaking, selling a part of the business, or selling the entire business, right? So it can be anything. It has different forms again. One is the sell off or partial sell off. In this, we do the slump sale of the business. So we will take all the assets and liabilities put together, we will take all the processes put together, and we will venture it out for selling. That is called as the sell off or partial sell off. Spin off. Spin off mean that again there are two businesses. One business we will create under a new company, like the question number 19 that we did, Fortune India and Fortune Pharma, right? That is spin off. Okay, then comes the split up. So split up is wherein a company is actually dissolved into different companies. And the company which is getting transferred into different companies, it loses its legal identity and hence it is dissolved. So split up means that one company comes to an end and different companies starts their own businesses, right, which are definitely transferred from the previous company. Equity carve out, again a very simple one, wherein there is a spin off, which is this one, and there is a issue of new equity shares in the market also. So to do that, we are issuing further shares in the market. So equity carve out means we are carving out, we are spinning off along with the issuance of new equity shares. Then demerger, division of the family managed businesses, that we have already seen, right? How we will demerge, how will you divide into different companies. So that can also be a divestiture. Now let's come to the financial restructuring part. So what happens generally, students? There are sick companies, right, which are having accumulated losses, which have no further business plans to revive, right? Their borrowings are heavy, their interest obligations are heavy, the creditors are not being paid, they are not able to recover their monies from their debtors, right? So there is no plan as of now to revive that we classify as a sick company. The moment the company is taken into a sick company, then it is referred to a insolvency professional. The what they will do, they will actually try to revive the company through some of the financial restructuring. Now, what sorts of financial restructuring they will be doing? The first one is, let's say they will be telling to drop down the equity shareholders value, the face value from 10 to 5, so that 5 rupees there is a gain that comes, right? The moment you say your equity share was worth of 10 rupees earlier, now it becomes 5, the company will get 5 rupees benefit, because in terms of the equity share value, 5 rupees need not be paid. Second, they will also tell company to restructure some of their loans or borrowings to reduce the rate of interest. Right? For example, if it is already 10% ongoing, can it come down to 9%? Can they convert some of the loans borrowings into equity? Right? Because the moment you convert it, you don't need cash to repay it back. Right? You immediately, I'm saying, till the time it is not dissolved, you will be able to mitigate the immediate obligations coming out of this. Then comes the working capital bit, wherein you will ask creditors to extend their timeline so that we can pay them later. We can ask our debtors to pay us on time so that the cash flows start coming in, right? So it's a matter of the profits as well as the cash flows, right? If the cash flows are not coming, there is no meaning to make profits there. So this is what it is in terms of the financial restructuring. Maybe some of the questions can tell you that if the company is undertaking these plans to do the financial restructuring, how can we arrive at that? Okay. Then comes the ownership restructuring. Now, ownership restructuring means that whatever ownership, or let's say whatever percentage of holding that we are having, can take again different forms. One is going private. So I think you would have heard the term going public, wherein the company from a private limited company becomes a public limited company by issuing the equity shares to the public at large. But there is a reverse situation also that is possible, which is going private. Under going private, you will buy back the shares from the market to become private. From the market, you will get back your shareholdings back, and you will again become a private limited company. Okay, because publicly, let's say there are lots of compliances and you feel that now those are not, I mean, the funding is not needed from the listing sort of a thing, you want to take yourself back, so that will come as a going private. MBO, which is management buyout. So one kind of M&A, which is whosoever is the management of the company, will themselves take over the company as owners as well. So whosoever is the management, they will become the owners. Leverage buyout, LBO. So this is a very important one. So leverage buyout means that you are buying a company, but you are taking loan for paying the amount, as we discussed, right, in our previous examples. So if you resort to this, then you will be called as that you have done a LBO, leveraged buyout. Clear, students? And why we are saying leverage? Because we are leveraging the loan that we are taking, right? On that we will be giving up the fixed amount, while from the business we will be earning higher. Then comes the equity buyback. It is also one form of ownership restructuring, wherein you will buy back your own equity from the market or from the shareholders, and you will pay them the amounts, right? You will say that, okay, 20% of my entire holding I will buy back. So that will lead to the ownership restructuring. Now, this is a new addition, students, which is Special Purpose Acquisition Company, SPAC. So these are the companies which are, gaining more attraction in recent days. So special purpose acquisition companies, their purpose itself is to acquire other companies. What do they generally do? They will do a IPO, which is initial public offer, raise funds from public at large. They will start raising the funds basis that IPO, and in their prospectus. So you would know, right? They will file prospectus. In their prospectus, they will say that this is a special purpose acquisition company. We will collect the funds and we will keep it with a trust, and we will then start searching our investigation about which are the companies to acquire, which are the good companies to acquire. After 2 to 3 years, once we close down this, right, then we will be investing those amounts into such companies. So special purpose acquisition companies are those which launch IPOs, collect amounts, keep the amounts in trust. Once they finalize the deal, they again take an approval from the shareholders that now the deal is finalized. We are planning to invest into such companies, acquire such companies, and then they will take back the amount from the trust and invest into the companies. So before finalizing the deal, approval from majority shareholders is required. Till the time deal is finalized, money is kept in an escrow account. Okay, they will keep it under a escrow account or a trust. Then after that, proper due diligence happens to arrive at the blank check companies. Clear, students?
Yes, sir.
Perfect. Great. So I think, yeah, on M&A, this was it. If you have any questions to be discussed or any specific question you want me to discuss from the recorded session, I'm happy to take it up. Otherwise, we'll move to the startup finance.
Sir, in exams, do we expect theory questions also in this?
Both. Yes, yes. It can be either ways. It can be theoretical as well as practical, both. See, practical questions, the formulas that we discussed, the concepts that we discussed, it will revolve around that, right? It's just that the questions might become tricky by eliminating one thing and asking for other things, but we have given great emphasis on those aspects as well. For example, the PE ratio, right? From whose perspective the question is asking you to calculate the gain or loss, whether it is from A limited or B limited. Again, one's gain is second's loss, and vice versa. So those things needs to be applied while we are solving the question, students. Clear?
Yes, sir.
Great. So let's come to the startup finance now, the next topic, right? So startup finance, students, is the topic which is related to a separate, I would say, the budding part of the economy, which is the startups, right? Which has gained a lot of traction in last 3 to 4 years, right? Although this as a concept existed earlier as well, but now, with more and more focus, with more people, budding up those ideas are into this, and hence the topic's relevance is that since startup is something which is at a very initial stages, at a very setup stages, then how or what are the challenges, what are the ways, or what are the overall things which we can understand from the financing part of the startup. Okay, now before that we'll have to understand one thing, right? What is called as a startup, right? We'll have to define what is a startup. So startup is defined by Government of India under a notification wherein it says that it has to be a private company, sorry, or a registered partnership firm or a limited liability partnership. Public company is not included. If you're already listed, you cannot be a startup. That means you're already established. So only smaller versions are included as a part of the legal entity. Second is that the 10 years should have not been elapsed from the date of incorporation, right? If you are already more than 10 years, then you are mature enough not to be called as a startup. Third, your turnover should be below a reasonable size. If it is beyond 100 crore, that means that means you are already scaled up and you are already having good amount of turnover. Split up or reconstruction of the existing business. So this means that while you can create a new private company, you are not allowed to split up or reconstruct your existing business, students. If you do that, so let's say we are already in a business of selling perfumes and we create a new company. First 10 years of incorporation is there, you create a company under private limited company, and turnover is also up to 100 crore. Will you still be called as a startup? No, because you are splitting up your existing business or you are reconstituting your existing business. Okay, so splitting up or reconstruction of the existing business will not take you anywhere in terms of the startup. If you are doing this, then it's not a startup. Then the fifth part is actually the innovation. There has to be some sort of a innovation, development, or improvement for product, process, or service. And it has to be scalable. There has to be wealth generation and there has to be employment generation because of this. Okay, so okay, sir, what is registered partnership? Where to register? So registered partnerships are basically the ones there where there is a deed of partnership that is registered. Okay, so that is called as the registered partnership. What I was saying is that for startups to qualify, they have to work around some sort of innovations, some sort of improvements, right? It's not that you are just in a business of restaurant and you will be called as a startup. What technology are you using to give that service differently? Is there some innovation? Is there some state of the art high level technology that will be taken up as a qualifying point for a startup? Okay, so the Government of India notification specifies that if you comply with 1, 2, 3, 4, and 5, then you will be taken up for the startup definition. Once you agree to the startup definition, then the benefits that are accruing to a startup, let's say cheaper credits, taxation benefits, or any other things, whatever it comes, the borrowings making simpler. So all those things will be extended to you. Clear? So this is the definition of startup. Now, next comes the innovative ways to finance a startup. Now, if there is a specific question student that says that what are the innovative ways to finance a startup, then we need to write all these things along with their explanation. This is again taken up from the study material there itself. So the first innovative way to finance a startup is personal financing. Okay, so the question is why individual is not part of the startup? Because individual, the sole proprietorship, again it has a very low legal standing in terms of the separability, in terms of let's say the separability of their own individual assets and what that sole proprietor is, right? So it has vulnerability attached to it. Tomorrow the things can go wrong. There are higher chances that if the loan is given, then it can be used for the personal purposes. But from a LLP perspective, from a registered partnership perspective, or from a private limited company perspective, these risks are lower. That's where the individual is not part of the startup. Okay. Personal financing. So personal financing means that you are using your own credit cards. Now, for example, this only, right? The same question that has come now, why individual? Let's say individual is having a credit card and they are using it for their own business, right? I'm not saying necessarily they are startup as per the definition, but they are using their amounts from the personal finances point of view. The personal credit line, sorry, the example that I gave is true for personal credit line. Personal financing means that whatever personal savings that we have will be used to fund the startup. Friends and family, wherein we borrow money from the friends and family by telling them that this is the idea and this is what we need to do. Peer-to-peer lending. So peer-to-peer lending means that one person is lending to another person and both of them are into the startups, right? If let's say today I have excess money and there is another startup there is another person who is engaged in that startup, so they will be able to exchange that amount under the peer-to-peer lending. Crowdfunding, this is very very important. So crowdfunding, there is D that we have to put. So crowdfunding is a funding wherein the amounts are sourced on a platform. That platform is also a startup, right? Wherein it will bring together all the people who want to invest in smaller amounts, and it will also bring in the people who are in need of the funds, right? So imagine a marketplace, imagine a platform where people are coming to invest, let's say 100 rupees, 50 rupees, 500 rupees, 1000 rupees, whatever is the ticket size that is defined on that platform. So those pool of people will evaluate some of the proposals on that platform and will start investing in those platforms. And on the other hand, there are these companies, these startups who are in need of the funds. They will put up their proposal on the platform. They will seek responses from the different people to get those amounts in. Clear? So this is where the crowdfunding is. And why it is called as crowd? Because there are too many people who are investing smaller amounts for the startup, right? Microloans are such loans which are different segments of the banks altogether, wherein they are investing in a where they are lending for this micro purposes, right? Vendor financing, students. Vendor financing is basically if I have to pay within 30 days as per the agreed terms, can I pay within 45 days? Right? So that 15 days I enjoy higher credit. Yes, credit period increase. So this is a way of vendor financing. Purchase order financing. Let's say I have a purchase order in hand from a customer and that's a valid purchase order to be fulfilled. What I will do is I will go to the bank, tell them that this is the valid purchase order against which I have to supply. Can you give me the credit? Or maybe I can ask my customer himself that can you give me some advance so that I can process your purchase order. That is called as purchase order financing. Factoring accounts receivable, students. So factoring accounts receivable means that whatever is my accounts receivable, get money from customer for manufacturing. Yes, you're right. In terms of the advances. Yes. Now, factoring accounts receivable will mean that I am already sitting with a receivable and I have to discount that receivable with a third party, maybe on a recourse or a non-recourse basis. Now, what does it really means? Let's say I'm having 100 crore receivable. I will go to a third party. I will get against that 100 crore, let's say 98 crore on today. And that party who is giving to me that 98 crore will recover 100 crore after 30 days from my customer. Now, tomorrow, if let's say some default happens, that default, if I have to make it good, that is called as recourse basis factoring. If tomorrow I don't have any liability to make the default good, that is called as non-recourse factoring. So non-recourse factoring essentially means that the risk is not transferred. The recourse means that the risk is getting transferred. Securitization is not part of the startup finance. Securitization was as a concept, it existed very early, right? It's an old concept. Startup finance has been a new one, okay? So recourse and non-recourse is clear and factoring is also clear. So in a way, I am able to realize my receivables well before time. Okay. So this was the example on crowdfunding that I discussed. So let's say there are thousands of individual investors which are having funds. There is an e-com platform in between. They are in need of the funds, right? So what they will do, company 1, company 2, company 3, these all crowd, they will go through the proposals of each and every one. Accordingly, they will decide where to invest. Now there was a concept of unicorn. Unicorn is a concept wherein your startup reaches a business valuation of $1 billion. The moment you reach at this stage, you will be called as the unicorn. Your startup will be called as the unicorn. Now let's come to the concept of pitch presentation. Now, as a part of the startup, you will have to prepare a pitch, a deck, right? Wherein you will list all the factors, all the challenges, all the ideas that you are chasing for in your startup, right? Because this pitch will be reviewed by the investors who are going to invest in your idea. This also will be reviewed by the lenders such as banks. This all will be even reviewed by the other people who are in the process of lending you some amount. Right? So pitch presentation comes with introduction, team, let's say the introduction of the founder himself. So the person who pursues that idea is called as the founder. The team under which that person, the team yeah, under which that person, the person's team will be working, right? So a brief intro about who all are engaged in what about their team. What is the problem statement? So that startup is going to solve which all problems that are existing for the consumers in the market. For example, Ola and Uber solve the problem of mobility, right? Quick availability of the cars. So, what is the problem that they are going to solve for? Then, obviously, the solution to it, right? The fourth point will be what is the solution that they are offering against this problem? Then, how they are going to market and sell, how they are going to distribute their product or services, whether they are going to ramp up their selling and distribution, or through marketing they are going to create a pull within the market. Yes, for example, Swiggy, they solved bringing the food to the customer place, right? So I mean, there are a number of problems. I mean, there are a number of problems against that. There are solutions which the startups will have to define and put it in their pitch presentation, right? Because if I am reviewing this, so you always think it of, let's say you are reviewing this. So what all things you would want to get it included within these presentations? Then projections. So you'll also need to include that what profitability are you expecting? What is the cash flow that you are expecting? How much balance sheet, how much working capital you will need in terms of a projected basis, right? Then, of course, about competition. Is there any existing competition on this idea? What are their strategies? How are they working? How are they moving ahead, right? So that is called as competition. Business model. How do we really drive the business model to achieve this solution for the problem statement that we have arrived at, right? Then financing. How are we really going to get this entire thing financed, right? What are the current options available? So these are things that will form part of the pitch presentation, students. Now, there is another section within startup finance which talks about the mode of financing for startups. Earlier, we have discussed about the innovative ways of financing a startup. This is a mode of financing for startup, right? Now, mode of financing for startup, it will include bootstrapping. So, bootstrapping means that looking internally what is available. So bootstrapping means looking internally what is available. For example, the trade credits, right? We can ask our vendors to extend the credit period from 30 days to 45 days, the same example that we discussed, right? Factoring on again recourse and non-recourse basis where you are receivable, you are taking up for the factoring. Leasing, wherein you are actually, rather than purchasing the asset outrightly, you are taking it on a lease, right? The second part is actually the angel investors. So angel investors, yeah. So Swaminathan is saying machine cost 100 lakhs and lease 1 lakhs per month. Yes. So in a way, you are avoiding the huge amount of cash flow as on today by just incurring the per month amount, and then it will give you the scalability also. Right? Tomorrow, if you want to change your machine, whatever you have paid earlier, you will not be able to recover it. Right? So this lease of 1 lakh per month will help you even in your adaptability and changes later on that you would want. So leasing is always a good option of lower investments initially. Then the second part is the angel investors, students. Angel investors are those who are actually very close by within the network of the startup founder, and they again invest behind the idea of that founder, and they're typically seen as an angel because they will not expect any return as such from their investments. Okay, so think about a situation or a narrative where a person is lending money to someone because of their contact, because of their network, and at the same time there is no, technically there is no bar on the fixed return that they expect, right? Then comes the venture capital. So venture capital are the ones, just a second, a student, just a second. Yeah, sorry students. So venture capitalists are those who are actually venturing it into a private equity. So there are two forms of equity, right? One is private equity and second one is the public equity. Public equity comes in the form of IPOs, right? Initial public offers. Private equity is actually coming in the form of private investments, right? Private placements. So the people who are not interested through going public, form of investments, they will search for some of the private limited companies. Again, private limited companies will be startups only, and they will want to invest into such startups. They will want to invest into such startups through a private mode, which is called as private equity. Okay. Venture capital and private equity is what we are going to discuss next. Okay, I will discuss in detail. So, this is how the private equity model works. So, there is a firm called as private equity firm. Okay, venture capital is part of private equity. Private equity is a bigger term. Venture capital is part of this. Now, what they will do? They will actually look out for possible investments in different companies. Okay, what they will do, they will create a SPV, which is in the form of a trust or LLP, right? Because that is where the money will reside. That SPV's responsibility will be to create a pool of funds, right? Pool of funds, they will collect from whom? They will collect from banks, financial institutions, pension funds, high net worth individuals, right? All of them, they will be asked to contribute to such pool of funds with the expectation that they will get decent returns on their amounts, right? Then what they will do, they will, using that fund, they will create the trust, and that trust will be managed by this private equity firm. Then they will do what? They will seek out what are the different companies to which we can give the private investments, private equity as the investments. Okay. The moment it happens, they will start investing the amounts in such private companies, right? Now, these private equity firms, they are called as the general partners, right? In this entire arrangement, they are called as the general partners because they take the decision where to invest, what to invest. Even their money is also at stake. They will also invest around 5 to 10% of the entire deal value. Majority of the money, which is 95% to 90%, comes from these, which are called as limited partners, because their liability is limited, right? So that's where they will not be asked to, give more money beyond their uncalled capital, right? Something like that. So limited partners are those who have already contributed, right? And their liability is limited. General partners are those who manage this fund, right? And there is a manager and advisor who will actually evaluate, who will do the due diligence of all the acquisitions possible. Yeah. Okay, sir, give the connection SPV private request pool of funds. Okay. So as I said that private equity firm, let's assume it's a X limit, it's a X firm. Okay. They will create a new SPV, which is, let's say, called as Y Trust, right? They floated in the form of a trust. This trust will be responsible to uphold these funds. These funds are held in a bank account, right? Those will be overseen by the trust, right? All these terms and conditions will be written in the document. And once these pool of funds, they will, the manager and this manager and the private equity firm partners, they will actually decide where to invest such funds so that the return is maximized. They will start investing there. So what they will do, they will buy, which is investment. They will even grow the investments, right? They will make it as 7 times, 10 times within 5 years, right? That's how the multiplier they deal in. And then finally they will sell. Let's say 7,000 minus 1,000, 6,000 is the profit that they will keep within 5 years. So here, the responsibility of these general partners or the private equity partners is not only the decision to buy, grow, and sell, but even they will be appointed to the board of the target company. Let's say S1 is the target company where they are investing, right? So they will be appointed to the board of such target company, and they will help them to take the day-to-day decisions so that they are able to grow the investment, they are able to grow their business, and hence the investment of private equity will also be on a higher side. Correct. So this is how the venture capital, the private equity structure is, right? Where are the startups? Startups are here, S1, S2, S3, S4, like this. So these are the startups within which the investments will come from private equity. This is another way of financing for startups. Okay. Now, in this again, there are 2, 3 different things that we need to understand. One is the domestic structure, wherein the domestic territory is there. Okay. In this case, what happens? Offshore and unified. Okay, sorry, wait. So domestic structure, we are saying that everything is within the domestic territory of India. That is called as domestic structure. For example, your private equity is also in India, SPV is also in India, pool of funds is also in India, and your investments is also sitting in India. So all these things are part of India. Those are called as domestic structure. Second is offshore structure. Now within this offshore structure, there are two. One is offshore and second one is unified. So the offshore structure will mean that SPV is outside India, the one that is created by them. The manager is in India who is taking the decision, and the investment is also in India, right? Only SPV, which is holding the funds, is outside India. In unified structure, investments will flow from outside, right? That means SPV is still outside India, and investments will also flow from inside, right? Apart from investment flowing outside, investments will also be flowing from inside. That pool of funds will be created and the SPV will reside outside, but the manager will be based out of India, who is taking decisions, who will help in taking the decisions of the investments, and hence this is called as the unified structure. Now, venture capital is one form of the private equity. So somebody may ask that, venture capital is Wider or private equity is wider? The private equity is a wider thing, which includes venture capital as one of the things. Characteristics of the venture capital, we all know. One, they have long-term horizon. That means they are looking for 3 to 10 years horizon, right? Then there is a lack of liquidity, students, right? They lack what is exactly, they cannot convert easily today's investment after 3 years also, because there is a gestation period. You will not be able to find easily the buyers for your stake. Then there is high risk, right? Because these people, they deal in the risky ventures, right? They will want to invest into the high risk, high return propositions. And then they also want the equity participation. I think you would have heard that I will give you 10 crores for 20% equity stake, right? These kind of conversations you would have heard whenever we talk about this environment within us, right? So So this is something that we'll have to keep in mind, that even they will ask for the equity participations. Okay. Yeah. And now this comes to the last part of the startup finance, which is the succession planning in business. So till here, I think the startup is over. Let me just quickly say about startup. So startup, we discussed that what is the meaning of startup as per the definition. Then second, what are the innovative ways to finance a startup? What are your personal ways available to finance, personal credit lines, all those things? Then the third part that we discussed is the modes of financing for a startup, right? Then we also discussed what element should be part of the pitch presentation. We also discussed about the venture capital and private equity. How do they play a role between the startup financing? Some of the new things that we would have heard is about the crowdfunding, right? Factoring, I think all of you would know. So yeah, I mean, this is how the startup finance ecosystem is working as of now. Now let's come to the succession planning, students. Now, what is succession? Succession is that for each and every role in an organization, there is a backup that is available. So let's say today, if some person leaves, there is a backup who can come and fill in that position. Why there is a need for a succession planning, first of all? See, one is it will help you mitigate the risk. The risk of what? The risk that, if the person leaves, who will take decisions in that person's place? Yes, business continuity plan. Very good, Swaminathan. Second is cause removal. So, cause removal is a term that is used wherein, let's say, some officials in the company are removed because they have done something wrong while discharging the duties, right? So, they have a cause to be removed. So, they are removed from the duties because of something wrong that they have done. Talent pipeline, right? So, it will also help in building the proper talent pipeline. Then next one is it will help in some of the conflict resolution, right? And definitely it will help in aligning. What should be the business succession strategy, students? The business succession strategy should be that first of all, we need to understand what are the key leadership positions in an organization, right? And we need to map what are the competencies required for discharging the above positions, right? Then, once we identify or map the competencies, we also need to understand as per the current workforce, where are we in terms of the competencies? Yes, leadership development. Very good, Swaminathan. So, we need to know that the current workforce that we are having, what is their competencies? Is there any skill set that needs to be changed? Is there any upgrading that we need to do? And finally, we also need to think about a bridge leader. A bridge leader is someone who will be able to take up. Let's say today the person has left, a leader has left, and the new person is coming after 1 year, because in the senior position it happens. So for 1 year, who will act as a bridge leader for us, right? So, these are some of the succession strategies that corporates are thinking currently in terms of the overall succession planning, students, right? We discussed why it is important to make sure that the business continuity is there. There is no disruption. Yes, very good, Swaminathan. I think you've responded on training, leadership, business continuity plan. Yes. So all those are the very basic bedrock of any succession planning in any business. And definitely from a strategy perspective, as we discussed, we will have to see what is the position looking like, what is the competency of that position, and what is the availability of the workforce. If internally you are not able to match up, then definitely externally you will look out and make sure that you have a proper successor planned in terms of any leave, right? So as to minimize the impact, students, right? Then challenges of succession planning. I mean, these are very clear, right? If you talk about startup, and if you're trying to do a succession planning of a promoter, how can you imagine a startup without a promoter? Because the promoter himself has ideated that idea for that startup, right? So you cannot replace or plan to succeed that particular promoter. I mean, there will be a challenge around that, right? Then second is, availability of talent, whether internally or externally, that will be the issue. So students, with this, the discussion on mergers and acquisitions, revision, as well as the startup comes to an end. Is there any other question that you would want to discuss or would want to ask? Please feel free. Let me check the query handle also in case something is there. Okay. I think nothing is there. So, sir, I hand over to you for the closing remarks. Thank you.
Thank you.
Thank you, sir.
Thank you,
Thank you.
Shiva sir. Now, student, with today's session, we have come to the end of our journey for the live virtual revision classes. Devasi, can you just stop sharing
Sure,
the
sir.
screen?
Sure, sir. Sure, sir.
So today we have come to the end of the journey of the session, live virtual revisionary classes. So in this journey, basically we have referred the earlier recorded lectures, and we hope that you must have gone through. Then you have come prepared in this class, and we have revised. Of course, somewhere we have provided new questions as well. Now, students are requesting that please sir provide the solutions of the questions. So earlier, yesterday, I have got uploaded some solutions of some assignments. Now, within 2 or 3 days, I will upload some more assignments. So that answers of the some more assignments, so that it will become easy for you. So when some student, I will also thank some student who have actively participated, or who I can say they have actively interacted with the faculty, and they make session more interactive. Now I thank Prashant Jain, Priyanka Sharma, Shweta Ajmera, Mukesh Khot, Resham Acharya, Abrakesh Mankarji, Samyanathan, Salesh Mane, Sachin Jain, and some students have come, but they could not join the term. But I'm just taking their name: Devrat Mahajan, Hasnath PV, Jatin, Manikandan C, Prabhas Jain, Parveen Gupta, Prithviraj Gorpade, Rajneesh Singh, Sita Galande, Yamunala Lakshmi Varun. So that I have name noticed during the interactions. So student, thank you very much. And if you have any query, as I told you, normally you can send us, of course, during the class you can ask, and even after the session you can ask the same query. Now student, we are coming out with the one series of open house session, wherein in a 5 days of a week, we have a, for each day we have a separate allocated day for subject wise. Like for AFM, it will be on Tuesday. Okay, so you can there will be open house session 4 to 5. Timings is 4 to 5. So in this open house session, we will be there. If you have any query, any type of relating to AFM, you are free to discuss with us. So I request you also convey this message to your friends as well, so that they come out well prepared for the exams coming to. So, and Samanathan, I think I have taken your name. Thank you, because you have actually, and even you have used sometime query handle as well. Now, Divas sir, just share my email ID and my telephone number, so
Sure,
that
sir.
student can interact with me, contact with me.
Sure, sir.
Samanathan, I think you want to ask something. Just
Yes, sir.
yeah,
Sir.
please.
Yeah, firstly, thank you so much for the Ford of Studies to bring this such a wonderful avenues for the students for the betterment of the studies purpose. Especially thanks for all the faculties. Really, they helped us a lot in the preparation and the revisioning all these things. Wonderful. Thank you
Thank
so
you.
much.
Thank you. Be staying with touch with us, and even if you have any query relating to study material, please you contact me over the telephone. Don't hesitate. My request to you, because ultimately, your contribution will encourage us to. It will help us the future students. Okay, because sometimes you have noticed some error, etc. Please discuss with me freely. So
Okay, sir. Okay, sir. Definitely, sir.
thank
So
you.
actually, in fact, the Board of Study provided study material,
Yes.
MTP, RTP, like the live virtual classes and the revisionary classes, and also like live discussion. Also, you have arranged for the next week, I believe, from 16th,
Yeah,
I
yeah.
believe.
Please join
Yeah,
me.
it's all wonderful, sir. Thank you, sir.
Thank you.
You,
Thank you. Thank you. And this is my email ID. Any student has, they can contact us at this email ID, or they can contact me over the telephone. So 0120 is STD code, and 304596 is my telephone number. So Divas sir, thank you very much for sparing your
Thank you,
precious
sir.
time and enlightening the student, and especially giving the practical view, because how the subsidiary work independently in today's
Yeah.
class. So
Sure.
thank you very much. Of
Thank you,
course,
sir, for the opportunity. Thank you,
thank
sir,
you.
for the opportunity.
sir,
Okay,
special
student.
thanks to Dua, sir, on this.
Thank you.
Thank you. Thank you, Samanathan.
Yeah,
Thank you.
I'm saying the special thanks to Dua, sir.
Oh, okay. Thank
Thank
you.
you,
It's a
Samanathan.
it's a compliment for you, sir.
Okay. Thank you.
Okay,
Thank you.
students. Thank you. Best of luck for your examination, and come out with a flying color in the September 2025 examination. Thank you. Have a nice
Yes.
day.
Thank you. Have a nice day.
Thank
All the best, students. Thank you, sir. Thank you.
Thank you.